Middays, we're coming at you, of course, live from the Element Wealth studio. We appreciate you joining us. It's our pleasure to welcome now to the program Gordon Fellows. He's the president of the Mississippi Bankers Association. Hey, Gordon, good to see you.
Good morning, Gerard. Thanks for having me.
You bet. So the big, beautiful bill signed into law by the president on July 4th, in the books, around 1,000 pages or so. Honestly, Gordon, haven't talked a lot about the impact that might have on financial institutions, banks in general, both those that are nationally chartered or state chartered. I'm sure you and others in your industry, in representing the good members of the Bankers Association, have called through it. What did you find out? How is this going to affect Mississippi's banks?
Yeah, well, great question. It is about 1,000 pages long. There are about 12 provisions that ended up making it into the final bill that we kind of advocated for and watched for. The first one that has not gotten a lot of media attention, but I think is really important, is the Consumer Financial Protection Bureau's annual budget was reduced. And this is a kind of a weird piece of policy, but when the Dodd-Frank law set up the CFPB, it exempted the CFPB from congressional appropriation authority. So they're an agency that regulates a whole bunch of things, but is not subject to congressional budgetary review. Instead, the Bureau has always gotten its funding directly from the Federal Reserve, and there was a cap on how much money the Bureau could request from the Federal Reserve each year. And the big, beautiful bill cut that cap in half. So that's an important, I think, oversight and restriction on the Bureau, and something that doesn't get a lot of attention. But this is an agency that has had a pretty deep impact on a lot of people in a lot of negative ways. And so this was an important step. Another, I think, really important piece of the Big Beautiful Bill Act for Mississippi relates to interest taxes paid on interest that farmers pay on ag loans. Traditionally, commercial banks, when they make an ag loan, have had to pay taxes on 100% of the earnings that the bank receives off of those ag loans, which makes the rate higher for farmers, right? The interest rate that farmers have to pay to borrow money. So for a number of years, almost a decade now, we've sort of been saying, hey, it's getting really tough to be a farmer. A lot of small farmers are getting squeezed out of business. You need to give us some new tools to help us reduce the rate that we charge farmers that want to get into the business. And so for new farm loans, under One Big Beautiful Bill Act, a quarter of the interest that the bank earns off of loans made to farmers will be deducted from the bank's taxes, which should mean that for new farmers, new loan originations, they see at least a minimal reduction in the interest rate that the bank charges them. So I think that's a really important, very technical, but important win for farmers in Mississippi. And then there are several other sort of important partial programs or not permanent programs that were made permanent. For one, for example, the new market tax credit program. This is an annual allocation that can be awarded for construction projects in underserved areas. That program was made permanent. That's been a 7-year or a 10-year extended program that's been extended by Congress multiple times. The Opportunity Zones program that Senator Tim Scott and President Trump sort of created in the first Trump term, and that's been beneficial to several projects in Mississippi. That program was made permanent. So those are a couple really important economic development tools that help local banks structure deals for new developments that were sort of in question as to whether or not they were going to continue to exist. And so taking away some uncertainty around those programs is really important. And then there are some really technical pieces in there, Gerard, about pass-throughs for sub-S's and EBITDA versus EVIT for certain calculations that would make for really boring radio for us to discuss. But so it's the kind of thing that I know you're paying attention to. So there's several really technical and
Yeah.
important changes that ultimately will, I think, have a positive impact on a lot of economic development programs around the state.
Okay, good. Well, geez, if I'd known we were going to be talking about EBITDA, I'd have worn my hat that's got EBITDA on the top of it. So that I used to play golf, and everybody says, "What is that?"
I was at a conference this weekend with a guy that had that on his shirt too. So we'll find the shirt and the hat, and you can wear them both.
I love it. That's awesome. Well, sometimes when you're in business, as I was, that's like your life. It's controlled by EBITDA. So, well. I'm glad you pointed out some of those things, because those aren't getting the media attention, as you know, and that's why we wanted to have you on. But one thing I keyed on was with respect to the interest, it's the revenue, right, to the banks from loans they make to agricultural customers. A quarter of that is excluded from their revenue. Is that how that works, or is it just deducted after they include it? It doesn't really matter. I guess it achieves the same outcome.
Yeah, a quarter of the interest income is excluded from the revenue calculation for the bank's income taxes. So which in effect drives the rate down that the bank offers those borrowers.
Yeah, assuming they're going to consider that in their loan terms and pass that through, which I believe they would. And that's important, is it not, Gordon? Because the farmers in our state have been reporting some difficulties in obtaining loans, which they rely on because they've struggled financially.
Yeah. So, last year when Congress did the big year-end appropriations package, Congressman Kelly and Senator Hyde-Smith were both real champions for farmer support programs that were sort of extended as part of that package. About $10 billion nationally was set aside to assist farmers that were struggling to make profit. And so, for this particular piece of the One Big Beautiful Bill Act, this is called ACRE, the Enhancing Credit in Rural Economies Act. And had the ACRE Act fully exempted all interest on commercial bank loans, we sort of calculated that was going to be around a $30 billion national savings for farmers. So 2 to 3 times what Congress appropriated last year. So we didn't get the full exemption. We got a quarter of exemption, which will reduce the rate, a fair amount, but it'll give us an opportunity to continue to have this conversation too, because it wasn't a full exemption. So yes, ultimately the farmers are going to be who benefits from this. It's an important sort of side piece. It certainly didn't get a lot of attention, but it's an important side development as part of this sort of bigger, broader One Big Beautiful Bill Act package.
Okay. And then the other big critical piece, I think, is the Consumer Protection Bureau there. That's something that was created back in the Obama era. That was post the 2008 financial crisis. It always seemed and felt like just gross over-regulation, overreach, way more than was needed, I guess based on what happened in 2008. It's always been my understanding, Gordon, that this was a particular problem and burdensome for community banks specifically. Is that the case, and is this going to make it a little easier to be a community bank?
Yeah. So the way Dodd-Frank set up the bureau, it gave the bureau direct regulatory oversight of institutions that are $10 billion and over. And so community banks are generally considered to be smaller than $10 billion, and so there was this sort of idea that they carved out community banks from CFPB oversight through Dodd-Frank, but the reality is sort of that every rule that the CFPB has promulgated has trickled down and had a deeply sort of costly impact on small bank lending. The most burdensome rule that I'm worried about right now is the small business data collection rule. It's called the 1071 rule. It was enacted by Section 1071 of the Dodd-Frank Act, but we've now had I think 4 CFPB directors, and none of them have been able to figure out how to do this in a way that would not cost small business borrowers sort of tremendously, and right. And if you think about Mississippi's, more than 95%, I think, of this businesses in Mississippi are small businesses. So
Yeah.
this rule would have a tremendous impact on the economy in the state of Mississippi. And so we, for over a decade now, have said, you got to get this rule right. Statute says you got to do it. But you don't need to create this in a way that constricts credit to small business borrowers. That would be catastrophic for Mississippians. And so the rule has been drafted. It's been litigated. There's been consumer groups that have sued the CFPB. There's been bankers that have sued the CFPB. It's been a real mess. The reason I bring this rule up is because at one point, in that first House draft
Hey,
of
Gordon,
the One Big Beautiful Bill Act, they actually delayed the rule.
We got a break.
Yeah.
Can you hang around?
Sure.
Can you hang around?
Absolutely.
Yeah. Okay, we'll be right back. With Pink Floyd's Money, we're talking to Gordon Fellows, president of the Mississippi Bankers Association. All right, so Gordon, please continue. You were just describing how this provision affects, in particular, the community banks with, I guess, the unraveling, so to speak, of the CFPB.
Right, and this particular rule, the small business data collection rule we were talking about before the break, is required under Dodd-Frank, right? So it's Section 1071 of the Dodd-Frank Act. So it's called the Section 1071 Small Business Data Collection Rule, and it's been litigated for over a decade. There are consumer groups that have sued. There are banks that are sued, and there's privacy concerns. There's competitive concerns. There's all sorts of stuff swirling around this rule. But as I was saying before the break, we have more than 95% of the businesses in Mississippi are small businesses, and so anytime that the gathering data about borrowers or loan applicants slows down how fast credit can get extended, right? Which sort of has a negative impact on small business cash flow, right? And which slows down business decisions, right? So this rule sort of, no matter what, is going to have a constrictive effect on small business credit just by the virtue of changing the timing of how small business lending works alone. So it's been a big challenge for us for a long time. I bring it up as part of One Big Beautiful Bill Act because I think it's a great example of how weird Washington math works. So in the House version, the bill that passed initially out of the House, there was a 10-year delay of the 1071 rule. That would have been a statutory delay, and they said I don't know who, I don't know if it was Congress or OMB or who, somebody determined that 10-year delay would have saved the country about $3 to $4 billion. And then in the House also initially intended to completely zero out the budget of the CFPB. When it got over to the Senate, that zeroing out the budget did not make it through the bird bath. But they allowed for a half reduction in the budget, right? So cut the budget in half for the CFPB. That made the bird
the numbers
bath,
work,
cleared the bird bath. Yeah, but because they weren't fully eliminating the CFPB, they were only reducing the budget in half. The savings on the rule that would have been recognized if they delayed the rule for 10 years no longer could be acquired because of the budget reduction, which doesn't make any sense to me. So part of the bill that originally made it through the bird bath ended up not making it through the final bird bath because of a change made by the bird bath, which is I think hilarious, but also it's a great example of how confusing the process can be in Washington. So ultimately, the bill ended up reducing the budget of the CFPB, and I think that's gonna free up lenders a lot in the short term to sort of feel like they've got some one particular regulatory sort of shackle taken off of them. The other thing that's sort of not part of this bill, but I think is an important part of this discussion, is now that we're several months into the new administration, a lot of the financial services appointees are beginning to settle in. So, for example, there's a new Fed vice chair for supervision, right? The ultimate bank regulator. Her name's Michelle Bowman. And she's been to Mississippi several times. I think you might have met her last year when you did your remote at Ole
Yep.
Miss
Did.
for the business school. But
Yep.
she's a Kansan. She was a state regulator at one point. She's worked at a community bank in Kansas that her family is involved with. So you got somebody that is now sort of the top bank regulator in the country that thinks an awful lot like a rural lender in Mississippi.
Hmm.
And so just sort of that personnel shift alone is going to be really important. And now that we're several months in, we're beginning to sort of see a coordinated effort within the administration to undo some of the sort of what I would call overly burdensome regulations of the last 4 years. Early in the Congress, there's this program that Congress can use called the Congressional Review Act that allows for, in a certain time frame, Congress to nullify regulations, and there were several bank-related regulations that were nullified early. And so those were some first steps that the new Congress and the new administration took. We're now past the time frame that those Congressional Review Act resolutions can be considered. So we were beginning to sort of move from Congress undoing regulations now to the administration sort of deregulating where appropriate. And we don't, I don't ever want to be heard as sort of saying we don't think we should be regulated at all. Banks should be regulated. Consumers ought to be sure, that the money where they're putting the money is a safe place, that safety and soundness is a focus. So when I talk about deregulation, I really mean it feels to us as regulated entities like the focus is now getting back on safety and soundness and not on a broader sort of assertion of regulatory authority beyond safety and soundness that we began to really experience kind of in the last 2 years of the previous administration.
Well, Gordon banks have understandably, as you point out, always been regulated. But, man, it seems like since the 2008 meltdown and then the Dodd-Frank, which I believe commissioned and created the CFPB and other
Right.
regulatory agencies. And, of course, it's a massive piece of legislation. It just seems like since then, you could argue that banks are the most regulated industry in our country, even more than healthcare, and it just feels that that's been a thorn in the side of banks. How do they feel about what's happening now with the big beautiful bill, with what appears to be kind of a trimming down of the CFPB and some of the other stuff you've been talking about? Is there?
Yeah.
Are they telling you this is good?
Yeah. So to crystallize your point a little bit, Gerard, since Dodd-Frank has in the 10 years prior to Dodd-Frank, the country averaged about 100 new bank formations a year. So about 1,000 new banks would be formed every decade. In the 15 years since Dodd-Frank has passed, we've only formed as a country around 100 or 150 new banks. So we're like 1,200 or so behind where we would have been prior to Dodd-Frank. So there's not very many new market entrants. And we've seen significant consolidation. And there's a lot of talk about rural healthcare consolidation, but there's just as much rural banking consolidation, right? When I started working for the NBA in 2012, we had about 89, somewhere between 80 and 89 banks headquartered in the state. We're down to when there's a pending merger right now. Once that's approved, we'll be less than 60, right? So we've seen a tremendous sort of shrinking of the number of banks that are in existence. And a lot of that's been driven by sort of this oppressive regulation and the cost. You have to scale up to absorb that cost. And if you're a small bank in a rural market, it's really hard to scale up. And so eventually you just sort of wave your hands and say, yeah, I'm done. And I think there's a lot of value in local banks having local bank charters. And so, I'm hopeful that we can get a little more stability.
Uh-oh. All right, see if we can get Gordon back to wrap it up. Of course, we're about out. You there? You got it, Gordon? He's trying to work on it.
Can you hear me?
We got you now. Yeah, continue.
Yeah. Sorry about that. So there's been a whole lot of there's been a lot of consolidation in the industry, and we're hopeful that we can get a little more consistency in the regulatory structure. It doesn't swing back and forth so much.
Probably getting a call.
Yeah, that may be interfering with his bandwidth there. That's what I'm thinking. So, okay. Well, really appreciate, of course, Gordon for coming on. If he comes back before this segment ends. Yeah, we got about a minute left, Gordon.
How about now?
Yeah,
I lost
good.
my signal there for a minute. So, sorry about that.
No problem.
But yeah,
getting to stability.
We're hopeful that we get a little more consistency, and that creates an environment where new banks can form.
Yeah, and that's good for the consumers, good for business when you got obviously more options, more choices, more competitions, as is the case. But man, these regulations have made it to the point where I just felt like that a lot of these banks wouldn't embark on consolidation because of all the hassles and the costs associated with it. Probably looking at the ROI on the combination saying, yeah, it doesn't make sense when you consider the costs associated with it. So, well, I'm glad that overall I think it's positive. It seems like you and your membership feels like it's positive. Got about 30 seconds left. Is that kind of your take on it?
Yeah, I think so. So it'll be interesting to sort of see over the next few years where this new administration takes the regulatory state, and hopefully, the allocation of capital can continue to be made at the local level with a good focus on improving communities.
Like it should be. Gordon Fellows, president of the Mississippi Bankers Association. Thanks, man. We'll see you later. Take care.
Good to see you. Thank you.
Yep. We're coming right back in the Element Wealth studio.